So let me introduce Ben Taatjes. Ben Taatjes is going to join us on the call here in just a second. He began his career working for a large CPA firm as a tax planner and a retirement financial advisor before founding Taatjes Financial in 2006. Another big milestone for Ben and the company was the writing of his book, Repurposed, and that has now led into Repurpose University. And again, if you follow our firm, you probably know more about that. Ben has a lot of tax knowledge because of his background. He does a great job of intertwining that into retirement planning. And again, he's here to talk about taxes, where taxes may be going, and how this plays into charitable giving. So without further ado, welcome Ben Taatjes to the show here today. Ben, take it away.
All right, Jared, thanks a lot. Yeah, I appreciate everybody tuning in. And I always love doing these things because it gets us the opportunity to get in front of a number of our clients and potentially some new friends of the firm. So thanks for tuning in. Like Jared said, one of the things that's unique about me as an advisor is I did get to spend a lot of time doing income taxes back in the day. And one of the things that I guess I have that I learned is retirees typically go through, whether you're a business owner or you're doing a lot of tax planning with a CPA while you're working. Sometimes when we retire, it's like, well, now the tax planning is done. And you get actually sometimes shifted to a different CPA in the firm, or somebody maybe a little less qualified, whether if you ran a business or something before that. And I think that one of the most important things that we can do for you as a client is to help with that tax planning with your CPA. I can tell you this, I saw so many things that I know work very well in regards to income taxes and retirees, and a few things that absolutely don't. So again, that we bring that unique perspective to working with our clients. So, and I still do enjoy taxation. I do. I think I don't enjoy the actual paying of the tax, but how the code works and different things that we can do to try to get around paying taxes. So, and I don't mind paying some. It's just too many. It becomes really a stewardship issue in my mind. So, last seminar we did talk a lot. If you can see my screen. Jared, working? Okay. We had a seminar back in May, right when we were starting to hear more and more about what potential changes were going to come up with Biden's tax plan. A lot of that stuff has been dialed back, which is the good news. We talked, so if you go back, and we'll have a link to this so you can watch that. If you're going to take anything away from that seminar, there are a bunch of strategies that we talked about that still work. We're hoping that some of the actual tax code changes don't actually happen that we talked about. So I'm happy about that. We'll see. But I don't have Biden's full proposal with us today. We're not going to go through it line by line because, I have, the most recent stuff here, but I don't know what's going to actually happen, and nobody does right now. But we do know, based on from what was in that call, some things are not going to be quite as we thought, but the strategies behind it are still very much there. And I do stand behind the fact that we will see higher taxes down the road, and they will impact retirees. We covered things like how we should have a full tax plan. Maximizing tax brackets, a huge thing that I think many people don't think about. We talked a little bit about QCDs. We're going to talk more about that today. Capital gains, Roth conversions, huge thing. And then also utilizing a wealth transfer plan, which is really, really important. One of the questions that I've gotten, and actually was a question even before the seminar today from somebody who's hopefully going to be watching, was, what are our thoughts regarding inflation? And with all this trillions of dollars being spent, how is that going to impact me? And actually, this individual had asked their wealth person, what's going to happen? And the answer was, well, not a lot, because, you're not a high enough income tax rate, or whatever the reason was. And I would strongly disagree with that. I want to come right away and say, even if the Biden tax proposal or the tax act is not going to directly increase your tax bracket next year, that does not mean it's not going to impact you. In fact, I'm looking at our next seminar already. We're putting it together, and it's not quite ready, but it is entirely around inflation and retirees. I'm not a hyperinflation guy. I don't think that we're going to see that. It's not a scare tactic, but go back 10 years and what did it cost you? And we were in a relatively moderate inflation. And if we do see higher inflation, that will impact you. So all this spending, whether it be through inflation, I think certainly corporate tax, corporate earnings are going to be impacted by the tax rate on corporations. There's a lot in the Biden proposal about how we could see share buybacks be limited, or not limited, maybe just taxed differently. That'll impact the stock market. We've seen things. There's just a ton in there. And I know historically speaking, people have always said, well, the middle class or lower class doesn't pay that much of the tax. And I know, and this is something from last seminar that you'll want to key in on, that historically speaking, and the data is in there in our last seminar, it's somewhere around 68 to 70% of the full tax load comes down to people that make more than $50,000 and less than $1 million. So when you hear it's only the multi-millionaires that are going to have it, the changes, it's not. Believe me, it will come from the masses, because they can't just tax the wealthy heavier and make up for all of the spending we're doing. So again, some of the stuff we covered last time, I'd encourage you to watch that, and we'll have the link available for you. So why are we talking about this today? Why do we think there's tax changes looming? Well, I kind of touched on it, government spending, right? We certainly, the next 4 slides will show you some of the issues we see currently in spending, a lot of increased non-defense spending, tax revenue. It's going to have to come from somewhere, right? And then we'll look at our middle class taxes. That big question mark is, are the middle class, are we going to be impacted or not? So first of all, growing spending is the problem. So if you've never been to the Heritage Foundation, it's a fantastic organization, heritage.org. You can find a lot of the same data that I used in creating this. But what I think is shocking here is if you see federal spending versus federal revenue. And by the way, it's not just the federal government. States look very similar, maybe not as bad, but you can see we kind of held in this baseline area. And if anybody remembers 2008 and 9, like I do, there was a lot of spending and stimulus. Remember how crazy that time was? Huge numbers with government, with bailouts for the banks. You saw your numbers rise, but they came back down. Here's your coronavirus or COVID kind of spending, and then it came back down. And now we have this consistent increase up where our federal revenue has been pretty flat. You do not have to be a mathematician to see that difference and what's happening there to think everything is going to be okay. It's not. There will have to be changes within the tax code. There'll be changes within certainly payroll taxes, a lot of other things to pay this back. And part of this, how it'll impact you is inflation. This is an interesting chart, and I wanted to bring this up because every once in a while we start grumbling about paying taxes, and we forget about the good in the taxes that we pay. I believe that I love living here. In fact, today happens to be Veterans Day, right? And if there's any vets on the call, thank you. I don't mind paying. I don't mind defense spending one bit, and I think we've spent money in the past. We've spent lives in the past that have given their lives for our freedom. And whenever I see this chart, it really does start to bother me. I mean, you see defense spending way down here, right or wrong, but that's not the issue. The issue is non-defense spending and all these discretionary programs, things like that. So again, those are the types of things that I'm watching and that concern me. How does the federal government even make it? How does it work? Where does all this money come from, right? We're talking trillions and trillions of dollars. Where's the money actually coming from? Another great slide from Heritage Foundation. Individual income taxes, that is a huge chunk of what we're looking at. And then it's payroll taxes, along with some other minor portions of income. So look at, this is kind of interesting. You see how corporate taxes have changed over the years. Here's 1950. Here's a projected and actual in 2020. Again, this has been pretty flat throughout. Individual income taxes, payroll taxes have went way up, corporate taxes have went down. So again, we'll see what changes and it happens from this newest Build Back Better Tax Act, but we don't know today is the point, but we do know spending is a lot higher than what it was, and we will have to pay that back. To the person who says this won't impact the general American, in fact, somebody who's probably, just living on their Social Security, lower income, they're not too worried about things. They don't have millions and millions of dollars. I want to show you this chart because there actually was a group, another case study kind of done on paying or spending a ton as a government, and specifically on non-defense and on different programs, government programs. Happened to be the EU. So this chart compares Europe versus US and what percentage of income somebody making $40,000 taxes they're paying. Payroll tax is huge, right? I do think that's a big part of how, again, you may not think it's going to impact you, but it will, as an American, will go up. Income tax is still a chunk of theirs as well. You've got a huge amount of sales tax. So again, when you look at $17,533 on a person earning 40 grand versus 11.6 where we are today, which looks better to you? Again, I know that this type of stuff will come if we continue to have so much discretionary spending. So that's why we're talking about this today. So, we can get really a handle on, this whole spending issue, and we can't solve it overnight, but they will, again, come back and tax higher. They will have to in various ways. We'll see inflation. There's a number of things that we know is coming, and we just got to be prepared for and make sure that our retirement plans are ready for what's next. Okay. One of the other things that I'm kind of a nerd, as you can see, I do a ton of research when it comes to the economy, when it comes to taxes. I absolutely love that work. And one of the things that I went back in my computer and found was back in 2014, the budget report to the US government. There's always a letter in the front coming from our current president, Obama at the time. And this is an excerpt from it. And there's the source if you want to read the whole thing. It's really long and really boring. But I highlighted this next page, something that jumped out at me. And one of the things that was interesting is, while there were some interesting things about how we're going to encourage retirement savings and some automatic retirement savings plans. By the way, this stuff didn't happen, but this was some of the things that our then president was talking about. And I'm trying to get you to shift your mind a little bit to what we could see. This is really interesting. Buried down in the bottom of that report in 2014 was this paragraph, and I highlighted it for you. They said specifically to prohibit individuals from accumulating over $3 million in tax-preferred retirement accounts. Individual retirement accounts and other tax-preferred savings vehicles are intended to help the middle-class families, but our current rules, some wealthy people basically have too much. And this is where it gets a little interesting. It says the budget would limit an individual's total balance across tax-preferred accounts to amounts sufficient to finance an annuity of not more than $205,000 per year in retirement, or $3 million. Interesting that you're actually seeing it's not taxes even, it's saying we're going to limit what you can have. And in fact, it sounds like they're also setting what is an okay income for somebody to have. That should set off all kinds of alarms in your mind when you read that. And actually, there's a little bit more of that in Biden's proposal right now, limiting the amount of how much a really high balanced retirement account could have, and coming back and potentially forcing distributions and therefore withdrawing those accounts down. So I think the mindset is really interesting right now behind that. So some things that have changed already. And again, when I'm talking about tax changes looming, this is all stuff that I want to set the stage for. The Secure Act, this goes back to December of 2019. This is the good news, okay? This was passed. And what they did is they said, if you are a retired individual, you don't have to be retired, I guess you just had to be over 70 and a half, and you're forced to take money out of your retirement account. And just to slow down a second, because I tend to talk too fast, if you are not 70 and a half yet, or 72, you probably have heard about this, but maybe don't understand it completely. The idea is all of these monies that have been put into your retirement accounts over the years, you got some tax favor treatment. They grew tax deferred. And the government says, well, you can't just let that go forever. So once you turn back before the Secure Act, 70 and a half, you had to start taking portions of that out based on your life expectancy, called a RMD, or required minimum distribution. What happened in 2019, which was the good news, was they said, well, let's give a couple extra years there. Let's go until age 72. People are working longer. Potentially, they might not want to have those distributions while they're working. So let's go ahead and change that to age 72. That sounds good, right? There's something else, though, that was in and here's some of the data behind that, or the information behind that right off the IRS site. That applied to, by the way, traditional IRAs, SEP IRAs, simples, 401ks, 403bs, didn't matter what type of plan you had, other than Roth IRAs, of course. But the Secure Act changed one other thing. The Secure Act said now, and this is the bad news, I think this is kind of the beginning of what's to come. It said, while we're going to let you wait a little longer to start taking money out of your IRA, once you pass away, you will not be able to give that to your children and let them take it out over their life expectancy, which we call a stretch IRA. So in the past, they would say you could pass that money on to your children. The money stays in an IRA. It's an inherited IRA, and you had their life expectancy essentially take that out slowly over time, so your tax burden wasn't so bad. Well, what happened, as you can see, there was a change. Designated beneficiaries who were not part of the eligible listed, which is basically a spouse and a few other individuals, have to now take that money out within 10 years of the person's passing. So what that means is I can either choose to, one, take it all out in year 1, or I can take all out in year 10, or I can take it out slowly over that lifetime or over that 10-year period, but I cannot stretch that out. So the reason I feel that that's an interesting thing that's happening is that means that the ability for the government to tax those IRA assets goes up dramatically when they can do it sooner rather than later, and they will push people into higher tax brackets and not allow you to push as much of that IRA money to the next generation. So a very interesting change there that a lot of people weren't probably thinking about. So why are retirement assets so important? You know, again, I think we as financial professionals will tell you over the years, put money into these retirement accounts because they'll grow tax deferred. If they're a Roth IRA, of course, tax free, but traditional IRAs and 401ks, they're going to grow tax deferred. Someday you have to pay tax, but you'll be in a lower tax bracket. Not always the case. We're not always in a lower tax bracket. And I think why this is so important to you is that the government knows just how much money's out there. And I got to tell you, they're licking their chops right now. They're looking at that as a great opportunity to recap some of this huge spending that we've seen. So there's actually a division of the IRS called the Statistics of Income Division. This was started back, I think it was in the 30s even, when they started, in fact, first few years that we had regular income tax. And they really track all of the ways that we're taxed and the tax revenues and who's paying what. Very, very interesting. Here is a chart that actually they had that we looked at, and this goes in billions of dollars. So these are not thousands, these are thousands of billions, which equals a lot of money. And going back to 2011 Q1, you can see how much is in IRAs, deferred comp plans, private sector defined benefit plans, state and local government defined benefit plans, federal defined benefit, annuities. These are all what we call income in respect to decedent. So you pass away, this income has to be taxed. You pull this money out while living, you have to pay tax on it. Let's go down here and see where we're at today. So this is going into Q2 or Q4 of 2020. So the number's even bigger than this now. That, people, when you have thousands of millions, is trillions. $35 trillion at the end of 2020. I see that, and this was in our last seminar too, as what we call the IRS jackpot. That money all has to be taxed. The acceleration of how it's taxed is really probably, to me, the biggest issue of something we need to look at. So again, we've got $35 trillion sitting out there waiting to be taxed. And a ton of that is owned by the baby boomer generation. In fact, there's some statistics on that as well, which I won't bore you on, but it is unbelievable how much more prepared the people on this call, retirees, are than the generation under you. That is going to be passed on in the next 10 to 15 years. And again, like I said, it's going to come out not over your kid's life expectancy, but a lot quicker than that due to the Secure Act changing it over the 10 years, okay? So what can you do? Last time when we gave this seminar, I went too slow, or we talked about taxation, I went too slow or too fast, I'm sorry, on kind of the end of the presentation, when we want to say, what can we actually do? What are things that you can do today if we think taxes are going up, or if we think there will be a problem down the road with IRAs? What are things we can do? And part of our talk today was going to be around charity. Okay, so year-end giving, charitable giving, things that we do with our clients every day that has just become the normal here. But many people still don't understand completely how these techniques work and why they're so important to use. So we're going to spend probably the next 20 minutes or so going through each and every one of these basically techniques. One of the things I love about our job is we do get to do, it's the technical aspect. It's the tools and techniques that allow us to save you tax. Again, like I said in the opening of the call, I got to watch and see people's tax returns. It means I saw other advisors missing things. I saw opportunities, things that I thought, oh, I wish they'd done this differently. And we got to see what worked and what didn't work. So we're not perfect by any stretch, but I do feel like we know more about the tax code and how enters, because that is our background, is in taxation. And we do a lot of things well, but I think we do that even probably the best. Okay. So we're going to talk about QCDs, beneficiary updates, and donor advised fund, and how those techniques work, and kind of how and why we like those tools. So the first one, and it's probably the one that I think needs the most time, just to wrap around why we think it's so important. Okay. So again, earlier in the call, we talked about IRAs and the tax deferral within an IRA. Okay. And whether that be a 401k or 403b, depending on what type of account you had, I'm looking at really all of those types of accounts. Now, if you have an IRA and you are forced into start taking your required distributions at 72, and actually this you can do at 70 and a half. We'll talk about that. Back in 2015, the qualified charitable distribution became permanent law. Up until that time, we were bouncing around, and some years we could give directly to charity, some years we couldn't. But now it's permanent. So it's worth thinking about and putting in part of your full financial plan, a regular qualified charitable distribution. And essentially, all you're doing is saying, instead of taking that IRA income in that you're going to be spending, you instead take the IRA and you say, I'm going to send a portion of it directly to a charity every year. Okay. So what a couple misconceptions around the QCD is, number one is, well, it's not permanent. Number one, it is. Other people have said, well, it's not very much money. It's just my RMD that I can send directly to charity. That also is incorrect. You don't just have to send out your RMD. You can send up to $100,000 per person per year from your IRA to charity. Now, many of you probably won't want to go that high, but you can. Okay. So that's another common misconception. The last one is, many people say, well, I'm not 72 yet, so I can't do that. I don't have a required minimum distribution. Like we talked about earlier, it's now at 72. So, well, I got to wait till 72. Again, that's also incorrect. You can start this when you're 70 and a half. So again, as part of our charitable giving strategy, we need to be using qualified charitable distributions. Remember, they have to come from an IRA. So if you're out there and you've worked over the years and you've put money into a 401k, you left your job, and now you're looking at doing this, it cannot come from your 401k. That's one of the reasons that sometimes it's advantageous to move that to an IRA. But you have to be able to do this in the right method, and you have to work with somebody that's done this. We do tons of them here. We've had clients say, well, I only give, $1,000 here and $1,000 there. Can I still do it? Absolutely. It does not have to be huge amounts. In fact, for many people, the biggest savings are people that give smaller amounts. If you are itemizing, so if you are, instead of using a standard deduction today, if you're itemizing, this is less important to you. So in fact, if you're giving less than, I think in a lot of people, look at the current numbers, and I'll just give them to you. The current standard deduction, depending on your age, of course, give or take 26 grand, okay, for a standard deduction. So if you're, so it's 25.1, unless you're over age 65, you get an extra 1350. So let's just call it 26 grand. So unless you're giving away more than, $26,000, now that you can also add into that your state and local income taxes, and there's some changes in Biden's proposal on that. You can add in medical expenses, but if those numbers don't get to be in excess of $26,000, when you give money to charity, it really isn't helping on your taxes of federal. It's not doing what you thought it was doing. Some people think that it's helping them offset taxes. It's not. But if you're able to directly give from your IRA, it will reduce your income tax. So it's something that I think even somebody who only gives $1,000 or $2,000 away, and you're over 70 and a half, you need to be using that strategy. Talk to your advisor about it. Talk to one of us about it, because it makes a ton of sense. So that's kind of the first one I want to cover. And if there's questions, put them in the chat. We can try to cover those in a little bit. But it's definitely something that if you're not using it, you're of that age, start using it. And if you're younger than that, guys, and you are charitably inclined, think about your retirement account as a great way to begin putting money away to give to charity someday. Okay. I know it's a strange concept, but I can tell you that if you can create a large balance in that IRA and be able to give that away in retirement, one of the things that I love to do with clients is do these QCDs. And that's not the only reason we give money away, is to save taxes, but it is a great benefit of doing proper tax planning, is being able to save income taxes. Remember, when you give money away, it doesn't cost you the full dollar, right? You're either deducting it, or for these folks are able to remove it from your IRA income. The next one I want to talk about, and this one's getting up, we're talking about this a lot with clients most recently, is updating your beneficiaries. A lot of people leave charities in their will or their trust as a entity that when I pass away someday, a certain charity is going to get some money of whatever's left over. Couple things there. I love to see people give while they're living. I think it's more enjoyable, but also there's many, many tax benefits to that, especially if you're not in a taxable estate. I'm talking income tax savings, okay? So one of the things that I'll do is coach clients and say, if your children are to inherit something in your portfolio, the absolute worst thing for them to inherit is an IRA, a traditional IRA or 401k. Any of these, what we would call income in respect to decedent assets. So IRAs are taxed both at income taxation and estate tax if you have a taxable estate. So double taxation, not a good idea to be passing those on to kids if you can help it. Okay. So I like to do is, if we have a situation where we have a client who has a large estate and they also have some money in IRAs, we review the will, trust, make sure. And again, we're not lawyers. I can't give legal advice, but if I see charitable intent and our client gives money away, we try to remove that for the most part from the will and trust and replace it with a charitable giving plan. So if we can create a plan, and if you have a $1 million IRA out there, and one of your goals was to give 10% of your estate to charity, it's just hypothetical, and that would be about 100 grand of that account. But let's say you're worth $10 million, okay? And I want to give away 10% of my total estate when I pass away. Let's remove that 10% from our will and trust, and let's name that IRA as a full beneficiary. Okay. If you're married, it would be a secondary beneficiary, of course, because your spouse may need that. But before I pass it to my children, I would rather pass that portion alone to charity, therefore making it non-taxable. Remember, charities don't care. They're not paying tax on it regardless. Okay. And then what we'll do as part of that plan is say, let's aggressively start over the next 10 years, giving that $1 million to charity. And we're going to take 100 grand every year for a period of 10 years until that account is gone, depending on growth, et cetera. You probably get some more years out of it, but let's use that as part of our giving strategy. And then once we're getting there, we can continually reduce the percentage of that account that is going to charity as a beneficiary. So we can create a simple plan that allows somebody to make sure they're giving the way they want to give in the most tax efficient way. Okay. So that's kind of a thought for you. If you have an IRA, again, big picture, remember that's not an asset that typically is good for kids to get when you pass away. I believe that if you're in this stage of life, you should be spending your money or giving it away while you're living. And if there's something left over, then give that to a charity and do it inside of your IRA as a beneficiary. Donor advised funds, another topic that I love to cover when we start talking with our clients about charitable giving. What I love about a donor advised fund is how it makes things more manageable for charity. Okay. Before I get to that though, I forgot, I've got to caution you. Some people have tried to do qualified charitable distributions to their donor advised fund. Does not work. All a donor advised fund is, I'll start there, is basically it's kind of like a holding. It is its own charity, and you're funding this with typically appreciated property, can be just cash. We use a lot of our clients will have stocks that have appreciated or mutual funds, and they'll send that money into their donor advised fund. And the entire amount that's in that fund is now can be used as like a long-term charitable giving account for you. So various vendors will set these up for our clients. But what I love about it is it lets you do a large gift in 1 year. Realize the full charitable benefit, but then actually drip that out to charities over years instead of all at once. You know, we use that a lot with our clients. A lot of people have found that it makes, instead of having a huge, if you have a land sale, for example, instead of having a large lump sum come into your church or charity all at once, it can go into your donor advised fund, the proceeds. And from there, you can be in charge of slowly sending those monies out to the eventual charities. Lots of charities, and if I'm looking at my local church, I know if they got a huge lump sum, would be a little overwhelmed by that. They probably don't have a division of their deacons that handles like investing money or it can be entrusted with that. So you can hold that, put it with a donor advised fund, and then slowly give those assets out to charity over years. Probably the most beneficial way to use it is, like I said earlier, to use appreciated property, whether that be stocks from accounts that you've invested in the past, or it could be land, appreciated business. You could put there's so many things that can go into these things. You got to think outside the box sometimes. Business interests. If you're out there and you're thinking about selling a business, there's so much that can go into them, and we're more than happy to help you really get that set up and see the beauty of creating. Really, it's a legacy. It's a steward fund that you're able to put money into and slowly give out to over time. The last point on there is it also can be a beneficiary of your IRA. So it's a question we get a lot is, my charitable intentions change over the years. I'm pretty tied in with this group and that group, but what if they're not there? And now my IRA had them listed. Many times we'll list a donor advised fund as our beneficiary of our IRAs for a client, or a percentage of the IRA. And then inside of that donor advised fund, once you pass away, now they disperse it or they hold it and your children can disperse it to those charities as kind of either memorials to you or your family, and just kind of a cool thing to do. But again, it simplifies it. So if you got 10 charities and you can't decide which one to list as your beneficiary of your IRA, list your donor advised fund, go in there and make those percentages as you see fit and change them whenever you see fit. So that's kind of a quick rundown on donor advised funds, why we like them, a caution there, what doesn't work well, and what you can't do, and then some ways that we've been using them with our clients. So that kind of wraps up most of the, the details of kind of what we want to talk about today. I kind of wanted to have, at least 10 minutes left to kind of handle any questions people had, and then make sure we get everybody out of here well within our hour that you've allotted. But there's so much more I could cover, especially when it comes to taxation. I could talk for hours on this, but I think big picture, the thing to understand from what we talked about today is whether it be income taxes, payroll taxes, inflation, many different ways, but it will cost more to live down the road. So we need to be doing things today to make sure that we're prepared for whatever changes are coming. And we believe there's tax changes that are looming, and there are certain things that you can do right now, just simple things to pay the least amount of tax possible. Jared, I'm going to bring up any questions if you had any that we can talk about.
Yep. One last call. If you have a question or a concern, feel free to just put that in the public chat. I'll give you another minute or two. We don't have anything posted here, but just one thing, Ben, as you were talking through that, it's early to mid-November now. You gave us 3 specific strategies. Are these all still on the docket for this year? Give us kind of a timing on what it takes to kind of strategize those and maybe even implement those.
Yeah, so absolutely. So QCDs, they're qualified charitable distributions. So be doing that soon. Don't wait till December 5 or 10 or 20. I mean, do that sooner rather than later. I know that there's some cutoffs here with our firm. We just went over them today in our team meeting. Of course, I forgot them, but yeah, I'd be thinking this planning in November to very early December for qualified charitable distributions. Beneficiary updates, to be honest, you have up until the day you die to do that. But since we don't know that answer, we have to be doing that sooner rather than later. And then the donor advised fund, setting one of those up takes very, very little time. But again, all 3 of these things, Jared, are part of really a strategy towards tax. It's a long-term thing. It's okay, when do I want to pay tax? The discussion is, where are my current tax brackets? Will they be going up? Will I pay more tax later? Should I be doing these donations this year or in January? Those are all parts of what we would look at with one of our clients if we were talking through some of this. But all 3 of these things, no deadlines this year other than December 31 technically. But if you're not working with us, I don't know what your individual broker would say on the QCDs on timing, but I would not wait too long. We have a number of our clients here that actually do their monthly giving to charity through their church, through qualified charitable distributions. And it's an ongoing thing that they just do routinely.
Yeah, I think bottom line is do it sooner than later. And again, whether you are a client of ours or not, again, if this has to be part of the conversation, and I think that you've hit that point home quite handedly here, Ben. This is a conversation. It can't just be about giving or retirement assets. It's got to be about the tax side of that. And that's what.
Yeah, everybody should have. I mean, we've had plans of how we're going to save our money, and I think so much work goes into how are we going to put money away so that someday we can retire and use that money. Well, very little planning typically goes into actually how are we going to pay tax. I think that needs to be a very key thing when people are looking at their retirement. And like I started the call with, unfortunately, many business owners stuff after they retire, they shuffle down to another CPA that may be less ready for those questions.
Yep.
And really, that's one of the more important things. You've built all this up. Let's do it in the most income and estate tax efficient way possible.
Mm-hmm. You also mentioned give while you live, which I think is something very interesting. It's kind of the old school way of thinking of estate planning and whatnot is, there's these documents in place, I die, and then there's a transfer of wealth at that point. We tend to call it kind of more of a wealth transfer plan, which is, again, not just transferring the wealth now over the course of time to strategize that from a tax perspective, but also steward the next steward.
Yeah, really, you're stewarding the next steward. It's a great way to put it, Jerry. You're preparing the next steward, and whether that be, giving while you're living. I love that from an income tax standpoint, certainly. But I think you're able to see what the charities are doing, and if you're doing this with your children too, passing some of that wealth on earlier rather than later, you're potentially they're able to. If you're transferring part of businesses or anything, you're able to start using up their tax brackets. There's a lot that goes into that we didn't cover here, but I think a key component to that, and that's something when I finished my my CKA training, and that's something some of you know, some of you don't, but in the last year did earn a certified Kingdom Advisor designation, which again, it just really it helps me correspond with talk with clients about more of the biblical side of what we do. Being a good steward is certainly a buzzword in the industry, but I think that starts with how God looks at money. I think that's where that originally starts, and it's a tool. But if we're not being a good steward today, our kids are seeing that. A great way for us to be great stewards is, of course, giving. But part of being a good steward is preparing your children to be a steward. Realizing I will not spend all of this. Somebody else is going to own my stuff. Somebody else is going to end up, utilizing the things that I have. So they better be prepared to make those same good decisions and continue on what you're doing.
Well, I'm checking the chat log here one more time. I don't see any questions on there. You guys are a nice, quiet bunch here today, which is just fine. Just a quick reminder, our next online seminar will have to do with retirement and inflation. And Ben, you and I were chatting about that even this morning. I think that is a topic we need to tackle sooner than later. So for those of you on the call or listening to the replay, be on the lookout. Likely that will come down the pipe here before the end of the year. I think that's a topic, Ben, we have to cover, because it kind of dovetails into this whole conversation that we've been having with all these seminars. So
yeah,
there are no
just
go ahead.
Way too many questions we're fielding every day on that, and there's way too much money being pumped into our system right now for that not to at least we're already seeing some of that. I mean, we saw Social Security give its biggest increase, I think, historically ever for next year. That was interesting. But again, the government knows it as well as you do. If you go to the grocery store, you see it. And I think to say, well, this inflation or the money that's coming that isn't going to impact us is missing. I think it's missing the tax side of it, but it's certainly missing how huge inflation will be on a retiree. And I always joke with retirees, it's, they say they got a fixed income, and typically, at least with our clients, it's, you have a fixed income, but it's fixed pretty high, right? The reality of it is, if expenses go up too fast and you're not keeping ahead of that, your purchasing power gets eaten up pretty fast. And maybe our next seminar, we talk too about inflation versus the dollar. I mean, a lot of people think, the US dollar going down in value would be the same as inflation. Way different things. So I think we could probably touch on some of that next time. I'll nerd out again and enjoy the research side, and then we'll present that. But I think you're exactly right. And the people that are asking those questions are right in asking them. Those charts that we looked at earlier in the seminar highlight the fact that we are spending an exorbitant amount of money, and a lot of it is on programs, and a lot of it will be hard to pay back. And we're really, I've got charts and other things I found that show how much we're really, our children, how much debt we're saddling our children with is crazy. Some of the numbers, if you're born today, just exactly what we've done. And I think the only way to come through that would be higher taxes, and certainly we'll see inflation. The truth is, the US government has wanted some degree of inflation, has been pushing that for a long time now. And there's several deflationary things out there. And this isn't on our notes. Hopefully compliance doesn't get upset with us, Jared. But the truth is, I mean, we've got an aging demographic. We've got baby boomers that are aging, not spending what they used to spend. If you're out there on this call and you're a baby boomer, did you spend more while you were working and earning, or more now while you're retired? Every one of you would answer, I spent more when I was working. Well, now this huge demographic is out of the workforce, and coming into the workforce, the next biggest group is, of course, the millennials, who, no offense to millennials, but many of them are still living at home. A lot of them are not fully in their income earning years. And let's face it, today, a lot of them don't want to work because of what the government's been doing. So I think the combination of that and technology, certainly holding back inflation, has been a fight with even the government in trying to push inflation over the last several years. Because again, if we pay back future dollars with lower dollars, if you will, and I've got a bunch of debt, that looks pretty good in my mind. So I think they want an element of inflation, certainly not hyperinflation. I'm not saying we're going there, but I think every single person that has retirement assets needs to be looking at that as a risk in their portfolio today. So we'll do a show, or we'll do a seminar on that, and hopefully it'll help out some people kind of quash some concerns. And I'm not a doomsdayer. I'm not somebody who's going to come in and say everything's over. I in fact think today could look, I mean, you look at economic background, it could look a lot like where we were coming out of World War II. High debt to GDP, a lot of growth, a lot of expansion talk, a lot of things could be really, really wonderful going forward. But we have to be ready, and we have to make sure our portfolio and our personal financial economy and retirement, that we have those dialed in for an inflationary environment.
I think you gave a lot of good points there, and also a good teaser for our next seminar. So folks on this call, go ahead and look for that down the pipe sometime in December, something about retirement and inflation. So we'll get that one ready here in the weeks ahead. No questions on the chat here today. Again, we appreciate you guys logging on, spending 45, 50 minutes with us of your day. We really do appreciate that. Whether you're a client or not, and you want to have a more detailed conversation about some of these techniques that have been laid out today about charitable giving, please give us a call. Our number is 320-222-4236. We'd love to get you on our schedule and to talk about these tools and techniques. So again, any last words there, Ben, before we log off?
I appreciate you signing on. And if anybody's on this call and they heard some stuff Jared was talking about, a purposeful retirement plan, just a quick plug. We launched this Repurposed You material earlier this year. And if you haven't taken it, we're deeply passionate about it. And we talk finances all day long with people, but unless your life is to the point where you're enjoying your life, your money won't matter. And this is a way that we can hopefully help retirees see how to make their life even better, just through finding purpose and finding meaning in retirement, which isn't easy. It's not an easy thing to retire. So if you haven't been through that, make sure you look to us. We'll get you a code. It's about a $250 value, a retail cost, but we'll get you a code because you were on the call today, and make sure you can go through that course. Because again, I love meeting with retirees. I love helping retirees with their money, but more importantly, we want to see you thrive in retirement. So.
Amen to that. Appreciate that, Ben. Thank you so much again for logging on to the call today. If you want to give us a call, please do so. Our emails are ben@taatjesfinancial.com, and mine is jared@taatjesfinancial.com. Feel free to reach out to us at any time. Guys, appreciate it so much. Ben, thank you. Thanks to everybody on the call here today. Have a great day, and we'll see you in December. Bye now.
Thank you.